Let's break down certificates of deposits or CDs, what they are, how they work, and when they might be a good fit for you and your savings goals. A certificate of deposit is a savings product offered by both banks and credit unions that locks your money away for a set period of time in exchange for a guaranteed interest rate. And unlike regular savings accounts, you are agreeing to leave the money in that account for a specific period of time, which can range from a few months to several years. So here's how they work. You'll usually call up your banker or go visit your bank, ask what CDs are paying. They'll give you a long list of all their CD terms with their associated interest rates and their minimum balances. And this could be different depending on what bank you're at, but it could be 1 month, 3 months, 6 months, 1 year, 5 years, just whatever that institution offers. And then you just pick one, and then you figure out what you're going to deposit. With these accounts, they typically have higher deposit limits to even be able to open this type of account. It could be $1,000, it could be $5,000, it could even be $10,000 to open up a CD. But you could put more. Then the bank pays you a fixed interest rate. Now, when the CD's over or the term ends, that's called the maturity date. And at that period of time, you get your money back that you originally put in plus the interest earned. And there's a few different outcomes you could go with. You can take that as cash. You could put it into a different type of account, like a checking account, a savings account. You can put it back into the same type of CD. So let's say we were in a 7-month, the 7-month CD's over now. We want to put it back into the 7-month at whatever the current 7-month CD rate is paying. So it could have changed between that 7-month period of time. Or you could put it into a different term. So you could do a 1 month or a 12-month. It's all up to you. But you'll get a grace period to decide what you want to do. You don't have to figure out what you're going to do day one. Just don't forget. Now, CDs are FDIC insured up to the legal limit, which makes them one of the safest ways to grow money, and that's a big plus, with more benefits being that it's predictable returns, the rate is locked in so you know what you'll earn over that span of time. There's no market risk, unlike stocks or mutual funds that fluctuate in value. They can go up, but they can also go down. CDs only go up. There are higher interest rates than that of savings accounts, so that's a plus. But there's things to watch out for, like that interest rate you're guaranteeing. If inflation's high that year and you've signed up for like 2% and that interest rate's 2%, but inflation's 5%, you've technically lost due to inflation, so that's a downside. Then another downside is the early withdrawal penalty. So if you take your money out before the CD matures, usually you'll lose some or all of the interest earned. And a lot of the times the interest isn't even paid out until the end of the CD. So when you pull out money, you're pulling out the principal balance and you're penalized on that principal balance and not even the interest. So you're getting penalized on what you originally put in. So you could lose there. Penalty fees could be anywhere from 1 to 5% of what's withdrawn at that time. Another downside to look out for is there's no liquidity. So your money is locked up and it's not a great place to store your emergency funds. Now let's talk about when it's a good idea to even use CDs. Well, a good one would be when you have savings that you know you won't need for a while, or if you want a safe guaranteed return, and if you're okay locking your money up for a period of time. Now, CDs are a great option if you want zero risk, fixed returns, and protection of your principal. Just make sure the term and the rate makes sense for you and your financial goals. Now, if you want access to your funds more frequently, I got a tip for you. You can build a CD ladder, which is typically where you stagger CDs. You open multiple CDs with different maturity dates. Say we open up a 3-month, a 6-month, a 9-month, and then money's available to you through different periods of time. Always compare interest rates before committing and check with your bank's terms, penalties, and early withdrawal options and see what's best fit for you. Hopefully this video is valuable to you. I'll continue making more videos for my beginner to banking playlist, and I hope to see you there.